Topic focuses on liquidity measures and liquidity management, both of which are critical for evaluating a company's short-term financial health and operational stability. Liquidity refers to a firm's ability to meet its short-term obligations using available cash or assets that can quickly be converted into cash. Effective liquidity management ensures that a company can continue operations smoothly, pay suppliers and employees, service debt obligations, and respond to unexpected financial pressures. Poor liquidity can lead to operational disruption, higher borrowing costs, or even insolvency. Investors and analysts closely examine liquidity because it directly influences corporate risk, financial flexibility, and long-term sustainability. The topic introduces several key liquidity ratios used in financial analysis. The current ratio compares current assets to current liabilities and measures a firm's ability to cover short-term obligations using short-term resources. A ratio above 1 generally indicates that current assets exceed current liabilities, suggesting acceptable liquidity. The quick ratio, also called the acid test ratio, excludes inventory from current assets because inventory may not be easily converted into cash quickly. This ratio provides a more conservative measure of liquidity. Another important metric is the cash ratio, which focuses solely on cash and cash equivalents relative to current liabilities. Analysts compare these ratios across firms and industries to assess liquidity strength and operational efficiency. Working capital management is a major component of liquidity management because it directly affects cash flow and operational performance. Working capital is calculated as current assets minus current liabilities and represents the short-term resources available for daily business operations. Efficient management of receivables, inventory, and payables helps companies maintain sufficient liquidity while minimizing unnecessary financing costs. Excessive working capital may indicate inefficient asset utilization, while insufficient working capital increases the risk of financial distress. Companies therefore seek an optimal balance between liquidity and profitability. Analysts monitor working capital trends carefully because changes in operating efficiency often provide early signals regarding operational improvement or financial weakness. Accounts receivable management is particularly important because delayed customer payments can strain corporate cash flows. Firms often establish credit policies balancing sales growth with collection risk. More flexible credit terms may increase revenue by attracting customers, but they also increase the likelihood of delayed payments or bad debts. Effective receivables management includes monitoring collection periods, conducting credit analysis, and implementing collection procedures. The average collection period and receivables turnover ratio help analysts evaluate how efficiently a company converts sales into cash. Slow collections may indicate weakening customer quality, ineffective credit policies, or operational inefficiencies, all of which can negatively affect liquidity and overall financial stability. Inventory management also strongly influences liquidity because inventory ties up cash and may become obsolete if not sold efficiently. Companies must balance the need to maintain adequate inventory levels with the cost of carrying excess stock. High inventory levels increase storage, insurance, and financing costs, while insufficient inventory may lead to production disruptions or lost sales. Inventory turnover ratios and days of inventory on hand are commonly used to assess inventory efficiency. Industries differ significantly in inventory requirements, making peer comparisons important. Efficient inventory management improves cash flow, reduces operating costs, and strengthens liquidity, while poor inventory control can weaken profitability and increase operational risk. Payables management represents another essential element of liquidity strategy. Accounts payable arise when firms purchase goods or services on credit from suppliers. By delaying payments strategically within agreed terms, companies can preserve cash and improve liquidity. However, excessively delaying supplier payments may damage supplier relationships, reduce credit availability, or signal financial weakness. Effective payables management balances liquidity preservation with maintaining strong supplier relationships and operational reliability. Analysts evaluate payable turnover ratios and payment periods to assess how firms manage supplier obligations. Significant changes in payment behavior may indicate evolving liquidity conditions, bargaining power shifts, or operational challenges within the company. The topic also discusses the cash conversion cycle, which measures the time required for a company to convert cash invested in operations back into cash received from customers. The cycle combines inventory holding periods, receivables collection periods, and payables payment periods. A shorter cash conversion cycle generally indicates more efficient liquidity management because less capital remains tied up in operations. Companies with efficient cash conversion cycles often require less external financing and maintain greater operational flexibility. Analysts use this measure to evaluate operational efficiency, compare firms within industries, and identify potential liquidity concerns affecting profitability and cash flow generation over time. Overall, topic emphasizes that liquidity management is essential for maintaining operational continuity, financial flexibility, and corporate stability. Liquidity ratios, working capital analysis, receivables management, inventory control, payables management, and cash conversion cycle evaluation all provide important insights into a company's short-term financial health. Effective liquidity management allows firms to meet obligations efficiently while supporting profitability and growth. Poor liquidity practices, however, may increase financing costs, weaken supplier relationships, and heighten insolvency risk. For CFA candidates, understanding liquidity measures and management is critical because liquidity analysis influences credit assessment, valuation, financial forecasting, and investment decision-making across corporate and fixed income markets.